Hey everyone, happy Thursday, July 27th. It's about 11:30 on the West Coast and it's time for another market update. Busy week in the market, busy week in real estate and housing news. Headlined by yesterday's Fed meeting coming to an end, and then announcing their new hike, which was a quarter of a point as expected. However, the more important part a lot of times with when their meeting comes to an end is their statement afterwards and a press conference afterwards. And in the press conference, Fed Chair Powell came across less hawkish than expected. Basically, laying the groundwork for pausing in September. So the bond market reacted pretty positively yesterday. Even though we got the hike, things were positive just because we knew the hike was coming, and they opened the door, like I said, for pausing at their next meeting, which will be in September. So that was positive, but they also made things come across very data dependent as far as, how things are going to going forward is going to depend a lot on those inflation reports and those employment reports. So it's going to be touch and go until then. So moving on, we'll get a little bit down in a second. But moving on, the other thing we got this week was the FHFA and Case-Shiller appreciation reports for home prices, and both of those continue showing things going up. So the FHFA first, this is the one that throws out jumbo loans, throws out cash loans. It came in at, again, a 0.7 gain month over month, down a little bit year over year, but again, that's year over year comparison, so still 2.8% year over year. And really, if you look at it year over year, down on the West Coast where, I know we had some home price declines, down negative 1.7% year over year. So not too bad on the West Coast. And again, the rest of the country propping those numbers up a little bit. And then the second one we got was Case-Shiller for May. Again, these are usually about a month behind. So these are all May numbers. Case-Shiller, this does include jumbo and does include cash deals. This came in at plus 0.7 a month over month, up from last month, and then down annually, down to 0.5%. From last month was down negative 0.1. But like we talked about, this is, again, year over year. We kind of said in the last couple of updates I've talked about this, where this was going to happen based on the previous numbers. But if you look at the, where home prices are going and what their 2023 pace are across the board, all these different appreciation reports show home prices turning higher. And if you look at this 2023 pace, even with Case-Shiller showing negative right now, it will end up at 5% year over year for the 2023 pace. So if you had bought a home for $500,000 at the beginning of the year, according to Core Logic, by the end of the year, it's going to be worth $550,000. That $50,000 in equity gained far would outweigh any sort of negative cost you had with a higher rate and all that. So again, never a perfect time to buy, but if you can afford it, it's always, a good time to buy because you're going to appreciate in the long run, just like this is showing. Even though people expected, home prices to come down, 2023 pace is showing nationally that things are going to get more expensive. So not good for the people that wanted to wait until prices were lower. Next thing we got was June new home sales. So new home sales, this is new builds. This came in at a little bit lower, negative 2.5%. And again, they did a negative revision to May as well, but they're still up 24% year over year. They're filling that gap with not a lot of inventory out there. So new home builders are still doing pretty well. Next thing we got was, along those lines, is June pending home sales. So pending home sales is existing inventory, basically a pretty good look at what's going on in the market right now. And that came in at plus 0.3%, so a little bit better than expected. It was supposed to be a negative percent loss for the month, and they're still down, though, a negative 15.6% year over year. So not good year over year, but it's interesting that number, that negative 15.6, that matches up. The inventory year over year is down 14%. So this isn't, rates obviously not helping, but this isn't a lack of people wanting to buy homes. This is a lack of inventory. Negative 14% less inventory, negative 15% less sales. So that kind of lines up, which is very interesting to me. Next thing we got was initial job claims. This was a big market mover this morning. Like I said, the Fed said they want to be more data dependent, so we got to pay attention to jobs going forward, before that next meeting. And this was expected to be about 235,000 new claims, and it came in at 221,000. So, good for people, good for the job market, like we've talked about before, less unemployment claims, but not good if the Fed is looking at that and saying, hey, job market is still great, we can rise again or hike again. Lowest number since February of this year. As you can see, it's been kind of on a downward decline. So again, good for the job market, good for labor and all that kind of stuff. But if the Fed's going to look at this and say, hey, we should keep hiking, that's not good for us. The next thing we got was purchase apps. Purchase apps down 3%, down negative 23% year over year. Again, rates are high, not a lot of inventory, so apps are going to be down. Then miscellaneous stuff with acute quarter two GDP. This was again something that negatively affected the markets this morning. Not a good day today, actually. QD was supposed to come in at about 1.8%, and it came at 2.4%. So again, data that the Fed has seen right after they made that remark about being data dependent, showing that the economy is stronger than expected. So again, good for America, but maybe not good for mortgage rates in the short term. And then a really important one, we got the CoreLogic loan performance, which they come out with every month. And as you can see, loans are still current homeowners, current loan holders are still doing really good. Borrowers, 30 days or more is down to 2.6 from 2.7% last year. 30 to 59 days ticked up a little bit, 1.1 to 1.3. 60 to 90 days ticked up a little bit, but 90, severely delinquent, which is 90 days, stayed even at 0.2. 120 plus days is down to 0.8, and foreclosure stayed at a really, really low level of only 0.3%. So that is good news for the housing market. That means, people are paying their loans, they're not falling behind, and that's great to see. And it's not good for the housing crash bros, the people that keep saying everybody's going to fall behind. But as long as the job market stays strong, as long as there's not a big employment crisis, then we could see, can people continuing to pay their loans on time. So where did that leave us? We're up to 7.09% today from 7% for the average 30-year conventional. It was actually ticked down to, I believe, 6.95 yesterday after that rate hike, but again, the bond market reacted positively. Today, though, with the job claims and the GDP and some banking terminal stuff going on, that's not good for bonds. That ticked up to 7.09%, and maybe might even tick a little bit higher. So not good, but going forward, what do we got? We got tomorrow is a big one. Tomorrow we get the PCE inflation data. This is the Fed's favorite form of inflation data. It's following up on the CPI inflation report earlier this month, which went well for us. We expect this one to come in good, and that's important. So, hopefully that comes in as expected tomorrow as a positive with inflation going down. This is a big one for the Fed to look at and kind of plan what they're going to do going forward. So if this does come in as expected as a lower numbers, then we should see some positive movement in the bond market, which means in mortgage rates. How much, it will be depending upon how good that comes in and what happens after that. And what happens after that is we got BLS jobs report, I believe next Friday, the 4th, and then CPI coming in on the 10th. But BLS, this inflation, we're pretty confident it's going to keep coming down for different reasons we talked about, shelter and things like that. The BLS jobs report, though, it's a little scary with job claims continue coming lower. Those are directly attached. That BLS jobs report number and jobs week overall next week will get ADP as well. It'll be interesting to see what those numbers come in. So, best thing for mortgage rates would be lower inflation and higher unemployment numbers. That might not be best for overall, though, so we're going to have to keep our eye on that. But, where do we go from now? Again, rates are a lot higher than we like. But it is what it is at this point. People are getting a little bit more used to, I think, these higher rates. And like I talked about before, it's still, there's never a bad time to buy. If you can afford the payment being higher, if you can afford, doing a cash out refi to pay off some other debts, you should do these things because now is the time to do it. Like we talked about, once inventory, once rent rates do come down with this low amount of inventory, that's going to kick prices even higher and it might even be harder to find that house that you might be looking for. So if anybody needs anything at all, don't hesitate to reach out and I'd be more than happy to help. Have a great week, everybody.